Hello, everyone, and thank you for joining me. I'm Felicity Cree, the Portfolio Director at BlueSky, and today I'm excited to present our final performance review. Our presentation today will move through 8 sections. We'll start by reviewing the purpose of this performance evaluation, why it's important for both accountability and strategy. Then we'll dive into our original investment themes, set that within the wider economic context, and look closely at our actual portfolio performance compared to our benchmarks. We'll also examine how individual stocks performs relative to their forecasted growth, and we'll close with the strategic shift we're making to build resilience and sustain performance into the future. This review serves 4 key purposes. First, it helps us assess investment effectiveness. Are we delivering capital growth and risk-adjusted returns that match our goals and investor expectations? Second, it enhances transparency. We're not just presenting high-level wins, we're also critically assessing where predictions didn't align with reality and where rebalancing might be necessary. Third, it supports smarter strategic decisions, such as whether to reduce exposure to certain sectors or increase allocation to more stable or undervalued industries. And finally, this review allows us to identify and mitigate emerging risks before they impact performance, ensuring we're proactively managing the portfolio, not just reacting to the markets. When we launched this portfolio, this strategy was firmly growth orientated. We committed to 100% equity exposure with the goal of outperforming the S&P 500 by 3% annually. We concentrated on high growth sectors, primarily the technology and consumer discretionary markets. This was based on historical strengths during expansionary periods. But the real success came from our willingness to adapt. We introduced an adaptive rebalancing strategy built on macroeconomic signals, valuation models, and predictive analysis. This allowed us to maintain a growth focus while reducing exposure to risk during volatile periods like COVID-19 and post-pandemic inflation. A few things stand out as consistent drivers of success across the portfolio's life cycle. We stayed strategically consistent. We didn't pivot dramatically with every market move, but we remained agile enough to respond to major disruptions. Our rebalancing was timely and based on both economic data and predictive modeling. We broadened our exposure over time, moving from heavy tech concentration to more diverse sector allocations. Finally, our stock selection was data-driven, blending quantitative screening with forward-looking macroeconomic analysis, enabling us to capturing the upside without excessively increasing our volatility. It's important to evaluate our portfolio it's impossible to evaluate our portfolio without considering the global backdrop. In 2020, GDP declined by 2.5%, unemployment surged to nearly 15%, and inflation became a dominant focus due to the supply chain constraints, stimulus spending, and energy price volatility. At the same time, central banks and governments provided historic levels of monetary and fiscal support, resulting in a strong market rebound in 2021. By 2022, economies had reopened, but we were also navigating rising interest rates and uncertainty around geopolitical risk. This era featured not just one economic cycle, but multiple overlapping ones. That required our portfolio to evolve and stay flexible without drifting from our long-term goals. Looking at the sector breakdown, technology was the top performing sector in 2017, 2019, and 2020. And we were well positioned during those rallies. Healthcare dominated in 2018, an area we had moderate exposure to, which helped cushion that year's volatility. In 2021, energy took the lead, a sector we underweighted at the time, which cost us some potential upside. This analysis reinforces that even a growth-focused portfolio must remain diversified across economic cycles. We've since expanded our scope to include infrastructure, utilities, and ESG-aligned assets to better capture gains during sector rotations. This chart shows our predicted versus actual portfolio value. By the end of 2022, the actual portfolio reached $347 million, closely tracking to the forecasted $358 million. That's a difference of just 3%, which is incredibly tight over a 6-year period, especially considering the volatility that we did face. This alignment validates the accuracy of our forecasting models and affirms that our risk-adjusted return expectations were realistic and well calibrated. It's also worth noting that our portfolio growth was consistent without sharp reversals or excessive downdraws, speaking to the effectiveness of our active management. On this slide, we take a deeper dive into how individual stock holdings performed relative to our initial predictions. This analysis gives us one of the most valuable insights from the entire review: how well our modeling helped in practice and where we needed to reassess our assumptions moving forward. Let's begin with the top 3 performing stocks based on their actual growth compared to what we predicted. First, Apple. We expected strong growth from Apple with around 429% return, but the stock delivered an incredible 714% return over the 6-year period. That's an outperformance of 285 percentage points, and it validates both our high weighting of Apple at just over 20% of the portfolio and our confidence in large cap tech as a core holding. Apple's post-pandemic surge and consistent innovation cycle made it a standout within our portfolio. Next is Martin Marietta Materials, a mid-cap in the infrastructure and materials sector. Our forecast projected 222% growth, but it actually returned a 282%, outperforming expectations by 60 percentage points. This was driven by tailwinds from the US infrastructure investment and pricing power during inflationary periods. While its weighting was relatively modest at 3.57%, it contributed meaningfully to our stable growth. Finally, a real surprise came from Credit Corp. We only predicted a 4% growth based on conservative macroeconomic expectations for Peru. However, the stock delivered 33% growth, which is a 29 percentage points in more than what we forecasted. As the largest bank in Peru, Credit Corp benefited from a stronger than expected post-COVID recovery. However, this has a relatively small 4.59% portfolio weighting, which limited its impact on the total performance. Now let's talk about the bottom 3 performers, where our expectations didn't match reality. The most noticeable underperformance came from Netflix. We had extremely high expectations. Our model forecasted an excessive 1,000% growth, but Netflix returned a 540% return. While still a portfolio position that was positive to us, it's still a 467 point shortfall. It reflects our over-optimization in our growth assumptions, especially in light of rising competitors in the streaming space and market saturation. With Netflix making up 14.85% of the portfolio, this underperformance was a key lesson in valuation risk. Next is Atmos Energy. We expected 143% growth, but it returned a 90% growth. A 53-point gap. Slower regional growth and regulatory constraints weighted on its performance. While not a major drag thanks to the 12.17% weighting, it's a good reminder to reassess how we value defensive stocks during inflationary environments. Finally, the Toro Company, which underperformed slightly. We projected 227% growth, but it returned a 200% growth, falling short by 27 percentage points. This isn't a major concern, but it does highlight that even strong companies can underdeliver when expectations are too high. In summary, this slide shows us that while our forecasting models held up well for some stocks, others, particularly like Netflix, highlight the risk of overvaluation and overly optimistic projections. We also saw the benefits of diversification. Stocks like Credit Corp and ExxonMobil exceeded expectations despite lower initial forecasts, reinforcing the value of holding a range of assets with different risk profiles. Moving forward, we'll refine our modeling assumptions, reduce our resilience on aggressive forecasts for high growth stocks, and focus more on valuation discipline and balanced positioning across the portfolio. This will mainly come from changing our 6-year outlook to a 3-year outlook, which reduces long-term market fluctuations. So here's a visual representation of our portfolio stock weightings over the past 6 years. In 2019, we made a deliberate decision to strategically shift our stock weightings towards a more defensive approach. We recognized the early signs of slowing within the global economy through the rising volatility and late cycle market conditions. So rather than to chase the high risk growth, we began rebalancing the portfolio towards stable income generating sectors like healthcare, utilities, and consumer staples. This proactive move has helped cushion the portfolio through recent economic uncertainty while positioning us for steady returns in a lower growth, lower inflation environment. You can see in this chart how our exposure gradually adjusted over time, reflecting a more resilient defensive allocation that aligns with today's evolving market landscape. Now let's evaluate our full 6-year performance using traditional benchmark metrics. So the portfolio returned 247.03% compared to the S&P 500's 110.87%. That's more than double the market's return and meets well over our expectations of the 3%. The Sharpe ratio of 12.55 shows exceptional risk-adjusted returns. We consistently outperformed while also maintaining volatility within our portfolio. The training ratio of 2.64 was another strong indicator of our ability to deliver return relative to market risk. The Jensen's alpha of 144% also highlights significant skill-based outperformance after accounting for risks and market exposure. And we did all this with a beta of 0.93, lower than the market baseline, meaning we weren't overexposed to volatility. This combination of high returns, controlled risk, and positive alpha speaks to the strength of our strategy. So now let's break it down to pre-COVID and post-COVID portfolio performances. In the first 3 years, we returned a 96.45%, while the market only returned a 42.9%. Our beta was 1.09, so we definitely took a more risky approach pre-COVID, which was appropriate given our high growth strategy. However, the Sharpe ratio and Trona ratios were lower than our full period metrics, indicating we delivered strong returns, but with more volatility and less efficiency. The Jensen's alpha of 50% is still strong, but it tells us that the post-2019 period is where we really sharpened our strategy. So after COVID, we shifted towards risk mediation. Our return was 61.90% compared to the market's 47.57%, still an outperformance, but with more modest margins. The beta dropped to 0.86, showing a defensive tilt. The Sharpe ratio fell to 2.58, and the Jensen's alpha dropped to 20%, which is lower, but it's a still positive outlook on our portfolio. This was a period of consolidation and risk control. We weren't chasing performance, we were preserving gains and managing uncertainty. That strategy paid off in terms of capital preservation in the total performance of our portfolio. So, Now, for the future of the portfolio, we're going to take a look at the economic outlook first and see how that transposes to our future projections and strategies moving forward. As we consider the future of the economy, there's three key indicators that are shaping our outlook: inflation, unemployment, and GDP growth. What we're seeing is a clear downward trend in inflation, moving from above 6% in 2022 to below 3% by 2025. This signals a cooling economy and reduced price pressures. And it reduces our price pressures, something that's central to our portfolio positioning. Unemployment has remained relatively stable, with only minor fluctuations, suggesting that the labor market is resilient even as growth slows. On the other hand, GDP growth is showing a steady decline. This reflects the broader macroeconomic slowdowns that we've been anticipating, and it reinforces the need for a more defensive investment approach moving forward. Together, these indicators paint a picture of a late cycle environment: cooling inflation, steady employment, and softer economic growth. It's this outlook that's driving our strategic shift towards more stable income generating assets, which I'll expand on in the next slide. All right, as we look ahead towards the future of our portfolio, our strategy is evolving to match the current economic environment. With inflation easing, GDP growth slowing, and unemployment holding steady, we're taking a more defensive stance. We're shifting towards defensive equity allocation, focusing on sectors that offer earnings stability and resilience, particularly in late cycle market conditions. These include high quality dividend stocks and defensive sectors that historically perform well during uncertain times. At the same time, we're reducing exposure to cyclical and speculative growth positions. This means that trimming high volatility assets and reallocating into more stable income generating opportunities. So, what does this mean for our portfolio? It means that we're looking to invest more in healthcare, utilities, and consumer staples. We're looking to open to dividend paying blue chip stocks and select global equities in stable, low inflation markets. Ultimately, this strategy is designed to enhance portfolio resistance and deliver more consistent returns as we navigate a slower growth environment. The future of the portfolio will be shaped by you as a shareholder. We will be conducting our shareholder vote for the future of our portfolio on April the 25th, which I will be also further expanding on our refined strategies more so on that date. The vote will help determine how far we lean into this defensive realignment, and we encourage your engagement throughout this whole process. So to conclude, our portfolio has delivered strong returns, outperformed benchmarks, and maintained excellent risk-adjusted performance. We've shown we can adapt to economic shifts without compromising our long-term visions. Our next phase is about broadening diversification, tightening valuation discipline, and enhancing portfolio resistance by moving towards defensive strategies. We're in a strong position here, and we're ready to build on it in the future. Thank you for your attention. I'm happy to answer any questions now. And if you'd like to follow up or request more information, either pre-vote on the 25th or post, you're completely welcome to contact me directly or visit our website. So I'll open the floor up now. Thank you.